We revalue the gold, 3,300. We take the proceeds with or without selling the gold. It's political suicide to sell the gold. However, we can do other things like hedge it, like lock in price without selling. Now, this is going to get a little bit wonky, but this is one of the things they can do. We're going to monetize asset, and gold is one of the most obvious assets. I don't trust the government, but unfortunately, we have to live with them. So that's my revaluation. It's going to happen, I believe, right? I believe that they'll do it reasonably responsibly, but not very responsibly. So let's hope they do it right.
Sometimes the most radical solution is one we've already used before. Gold revaluation isn't a fringe idea. It's a page from America's playbook, and Vince Lanci thinks it might be about to make a comeback. Lanci makes it clear this isn't about some wild leap to $10,000 an ounce. That's not realistic. Nor is it simply matching the current market price. But a meaningful, deliberate bump? That's entirely possible. And if the debt keeps ballooning, it might even be necessary. The US has done this before. In the early 1970s, Washington raised gold's official price, instantly increasing the value of what was on the government's books. But back then, the windfall was squandered. Instead of fixing spending habits, the extra value was treated like free money, and the economy paid the price. This time, Lanci sees a smarter route. The U.S. Constitution prohibits selling the nation's gold unless it's used to pay down debt. That's an underappreciated safeguard. The idea would be to revalue the gold, record the higher number on the books, and then use that paper gain to retire part of the national debt. Selling the gold outright would be politically explosive, so Lanci suggests a hedge instead, locking in the new, higher value without moving an ounce. The proceeds from that hedge could then be deployed to buy foreign bonds or currencies. Doing so would naturally push the dollar lower against those currencies, making U.S. exports more competitive. The twist, according to Lanci, is that this isn't just a domestic debt fix. It's also a way to nudge currency values in America's favor and strengthen trade relationships, all while the gold stays right where it is, deep in storage. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Revaluing gold is very realistic. If things do not turn around soon for the debt situation, it might become a necessity. Now, I want to spend time on that, but I want to address the things that you said first. First of all, will we revalue it to $10,000? No, that's idiotic. We wouldn't do that, right? Number one, just to go down the list, right? Will we revalue it to its current price? Possible. I don't think likely. Will we revalue it significantly higher? I think so. I don't know how much higher, but I think higher. Look, historically, and we did it in 71 and 73, gold being revalued is a one-off, right? I mean, they raised the price, just the mechanics of it. They raise the price on the books that we carry it, and then the government borrows that much less, or they spend that much more. Essentially, you're tapping a piggy bank. It does not serve us well on its own. It's like, giving an irresponsible child more money without telling them to stop spending money on video games or something like that. So as a one-off, it's irresponsible. We irresponsibly did it before. We took it from like 35 to 42.20. We spent the money, and it happened right before the oil embargo. So it just was a disaster, and it was used irresponsibly. Now, there's some important details of this, and there's some important other things floating around that hopefully I'll be able to tie together. But I want to start by looking at the debt situation. With regards directly to gold, all right? The way it could materially help the U.S. Now, I'm echoing something that's already out there, the Mar-a-Lago Accord, whatever Stephen Moran talked about it. But I want to try and set it straight for people. The way it can materially help us and do so without being irresponsible would be to revalue it and, pursuant to the Constitution, use the proceeds to literally retire the debt. Now, I'm not the first person to say this. Grant's Interest Rate Observer had a nice article on it. A couple other professors talked about it. The Constitution has an amendment, and the amendment is that you can't sell gold, our gold. Our gold cannot be sold unless it's directly used to retire the debt. So it's a way to tie it to the deficit, and it's actually pretty wise. But what I described is to retire the debt or to lessen our debt, to use the price of gold to lessen our debt. So the first one would be we raise the price of gold. Let's just say we raise it to 3,300, right? I don't think we will, but let's say we do 3,300. And then we can just basically change the accounting ledger to have more money and take that money and do what with it? Well, if you were to go out and buy the debt tomorrow, bonds would explode and we'd be paying a high price for them. It would be bad. You can take that. So that would be stupid tactically, right? But it would be the right idea, right? A smarter idea would be, and other people have talked about this, would be setting up, was it Andrew Jackson, a postal fund, or was it Hamilton? I forget who it was. Set up a postal fund, the guy with the tall hair. And that postal fund would be, you put the money in the fund and then you trickle it out buying treasuries from time to time. So those two examples, the aggressive one and the patient one, those amount to a QE. It's a gold quantitative easing. You're going to put money into the market by retiring our debt. It's fabulous. Now, it's not easy to do. In order to spend the money on a full revaluation, assuming that we had a full revaluation, you would need to sell or hedge the gold. Now, I'm echoing what Stephen Moran said and a little bit of a loophole that he's working with here. So here we go. Here's what I would prefer, which I think is actually doable. We revalue the gold, 3,300. We take the proceeds with or without selling the gold. It's political suicide to sell the gold. However, we can do other things like hedge it, like lock in price without selling it. Now, this is going to get a little bit wonky, but this is one of the things they can do. All right. We literally buy bonds of other countries whose currencies we wish to strengthen versus the US dollar. Now, you're going to have to just assume that you're going to have to take this as an assumption that's true. If you take dollars and you buy other currencies or other countries' bonds, you are retiring US debt. Of course, you're buying someone else's debt, but you're retiring US debt. Okay. So that is a way to not necessarily honor the letter of the law, meaning we have to retire debt with it, but honor the spirit of the law, because it's just a fact. If you take US dollars and you buy someone else's bonds with it, you're retiring US debt. Yes, you're swapping US debt for some other country's debt, but you're doing it with a trade partner who is going to be buying your stuff. So there's a loop. You're creating a loop there, and that's my in my naive way, that's my preferred way of doing it. Now, there's precedent for this. We have something in the United States called the Exchange Stabilization Fund, affectionately known as the Plunge Protection Team. Now, what the Plunge Protection Team does is, using various financial means, they will stabilize markets when they need to. And one of the ways you can stabilize a market is, the gold price is too high, then we're going to sell it, or we're going to hedge it, and we're going to take the dollars. It basically comes down to the dollar. If the dollar's too strong, we get dollars and we buy someone else's currency. Kind of like when there's a crisis in Europe and they need dollars, we will swap dollars for their currency. Where do you get the dollars? Well, you get the dollars in the Exchange Stabilization Fund from their fund. And it's not a lot. It's only tactical, and it can only be done for short periods of time to avert a crisis. This, what I just suggested, which is a variation of Stephen Moran's version, is a full-blown implementation of this tactic into a full-blown strategy. All right, so we've got tons and tons and tons of gold, allegedly, right? We hedge it by selling it forward. We don't sell it, but we hedge it. And then we take the funds and we go out and we buy. Who are we negotiating with? Who do we want to buy our goods? Japan. We want Japan to buy our cars? Well, we need to make the dollar weaker, right? So we will then take our dollars and buy yen with it. It makes the dollar weaker versus the yen. It makes them more likely to sell us to sell more cars to them because our dollar is cheaper, and it closes the it's kind of like a Plaza Two Accord, one deal at a time, one bilateral deal at a time, and I think this is something. So that's the whole mechanism of it. I mean, I didn't want to go down a rabbit hole too much, but I think there's a lot of misinformation. Is such a common word, such a nonsense word, but there's a lot of error out there in understanding this. Everyone's in love with Stephen Moran with his Mar-a-Lago Accord, right? That's what they were talking about a couple months ago. And although it was officially put on the side, he actually said this in a public statement. They're starting to do it. They're starting to do things in it, and I'm seeing that. And the bilateral deals that he's negotiating. Now, what the Moran idea is, what I said, only literally selling the gold. And he even says it's politically unexpedient. It's politically a third rail, something like that, he says. And so he wants to take the gold and sell it and take the proceeds and buy other people's currency.
When central banks quietly shift their playbook, it's rarely about today. It's about where they see the world headed decades from now. Vince Lanci says gold is at the heart of that shift. Currently, gold accounts for approximately 20% of global central bank reserves. According to Bank of America and Goldman Sachs, the long-term target appears to be closer to 30%. That's not a minor tweak. To achieve this, central banks would need to purchase approximately 50% more gold than current levels. The reason is simple. Without revaluation, central banks are stuck holding mountains of depreciating assets, government bonds and fiat currencies, many of them with negative yields, that are worth far less than their face value. Those losses aren't going away. Revaluing gold plugs that hole without forcing governments into harsh austerity programs that would be politically and economically painful. Lanci points out that even in times of peace, traditionally a bearish backdrop for gold, the structural forces remain bullish. Government spending isn't slowing. Deglobalization is reshaping trade flows, and the steady diversification of reserves away from the US dollar continues. All of these keep a firm floor under gold prices. The real inflection point, he says, will come when that 30% reserve share is reached. At that moment, an official revaluation becomes almost inevitable, not as a speculative moonshot, but as a policy move to align the books with reality. That shift would instantly change the face value of gold on central bank balance sheets and, in doing so, recalibrate the global financial system itself. Let's get back to the interview.
We're going to monetize assets, and gold is one of the most obvious assets. Now, Tom Luongo, who we're friends and we're mutuals, he had focused on the housing, Freddie Mac, Fannie Mae, and he's correct about that. There's other things that we could do too. You could offer people home equity loans, HELOCs, right, tied to treasuries. And in doing that, you tell them, we'll give you a loan against your treasury, against your home equity if you put it in stock. So we're just kind of extending and pretending a Ponzi. But those are things we could do. But I'm sorry, I digress. The real reason what I'm describing will have to happen, whether it's Stephen's way, whether it's my way, whether it's Grant's way, or whether it's anyone else's way, is as government. Now we got to go out to the fiscal problem. Every country has to spend more money, right? As government ratchets up necessary spending on social safety nets. In Europe, got all these immigrants coming in, right? Rearming militaries. In Europe, they have to defend themselves now that we're withdrawing from NATO, and we have to modernize our military as well. And rebuilding supply chains and factories. All that's money that's being spent. That's spending money. That's inflationary. And it may be for a good cause, but it's inflationary. And the fiat, the debt will balloon, the fiat will devalue. Fiscally and monetarily, this will be very, very bad. The Fed won't be able to raise rates. This is like a current event now. The Fed, in raising rates to slow down money, will actually increase our debt burden because we'll have a higher interest rate to pay. So it really kind of puts the Fed in a bad spot. Now, tapping the piggyback will keep balance sheets whole. That's good. Tapping the piggy bank will allow us to unlock value without spending it. Now, spending it by retiring debt is what I mean. And allow central banks to fight inflation if they choose to do so without jeopardizing their nation's well-being. So at some point, now I'm going to bring this to something the Bank of America said 4 months ago and said again. Michael Hartnett, their CIO or CTO, CIO said this weekend. So it's just current events. At some point, as central banks are buying gold, that's what they're doing. They're buying gold, right, to de-dollarize. Why are they buying gold? Well, they're buying gold because they need something to diversify their financial risk. They need something to go in and buy stuff in China. If you need gold, right? You need to get out of the dollar risk. Well, in doing that, they're going to be seeing the gold go up, which is what we're seeing, and the other fiat that they have go down. So I'm a central bank in let's say Europe. I've got euros, I've got yen, I've got dollars, I've got gold. I now have 20% of my gold. Now, Bank of America said about 4 months ago, and Goldman said something very similar. They said that central bank buying will not stop until they go to 30% of their portfolio. Right now, they're 20. So they have to increase their buying by another 50%. And the reason for that is when you look at the diversification, kind of like when you're diversifying your stock portfolio, when you look at diversification of currencies, you need to have ideally roughly 30% of your money needs to be in gold to balance the losses that you're going to have from the fiat. So we need to do that as a central bank to offset our losses. So as the fiat's going down, the gold's going up. But no one's marking the gold to market on their books. It's being marked at whatever, $42, $5, whatever. So at some point, the most logical choice will be when they have their 30%, not before, when they have their 30%, you raise the price of gold. And this has happened already. They've done, and going back to the paper that you brought up in the beginning, which I read, and I'll come back to their opinion on why they said what they said. But when during the creation of the euro, they revalued gold to ease the stress on balance sheets at the central bank. I believe they're going to do that again. Now, we need debt relief, or more specifically, as currencies drop and bonds drop, the Feds, the central banks will just lose money, right? I mean, how many NERP, negative interest rate bonds do the governments of Europe have, like, on their balance sheet? Those are worthless. Like they're so unless some alien lands, right, and wants to buy our treasuries and euro bonds and Japanese government bonds, unless someone lands like on Earth and says, "I'll be a new buyer," well, if he doesn't, either we do this or we go full austerity. You have to tap the biggie bank, and that's what's going on. Now, I wanted to just touch on what Michael Hartnett said. I don't have his quote in front of me, but I did 2 pieces on that this weekend. And in he has a report called The Flow Show, and it's very popular. Zero Hedge alerted everyone to his work, and I started to pay attention when he started talking about commodities. He's an equity guy for the most part. And he goes through this list of why gold will withstand peace, straight up, right? And his peace is bearish for gold, and here's why that doesn't matter in the long run. 1, governments need to keep spending. 2, governments need to deal with immigration. 3, some of that is a little bit bizarre, but 3, governments are more isolated now, which goes to my point about supply chains and military spending. He goes through all these things, and the last thing he says, almost like a throwaway statement, I mean, really, he says, central banks have 20% of 20% of their reserves are in gold, and 30% is where they're headed. That's from another report. And he goes, not I think. I mean, it's obviously his opinion, but He says central banks have 20% of their reserves in gold. At some point, they will have to revalue to offset the losses and everything else. And he's right. So we're going to have it happen. What's the price? I don't know. What are they going to spend it on? I don't know. They could end up going out and buying fart coin. Like I don't trust the government, but unfortunately we have to live with them. So that's my revaluation. It's going to happen. I believe, right? I believe that they'll do it reasonably, responsibly, but not very responsibly. So let's hope they do it right.
Recasting the role of gold in the financial system could serve as both a fiscal repair tool and a strategic lever in global trade. By lifting its official valuation, governments could unlock balance sheet strength without liquidating reserves, all while subtly reshaping currency dynamics in their favor. This approach sidesteps the political backlash of outright sales, preserves national stockpiles, and provides a path to manage swelling debt loads with minimal disruption to domestic markets. In a world where reserve diversification is accelerating and traditional assets are losing their shine, such a recalibration could redefine the foundation of monetary stability for decades to come. If policymakers adopt this approach, would it signal the beginning of a controlled financial reset or the first step toward a much larger transformation of the global monetary order? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.